right, Jay, we're talking about cash again. That's one of our more popular episodes, this holding cash episode that we released recently.
Yeah.
And it's kind of no surprise, actually, because cash is a big topic. Inflation is up.
Totally.
Interest rates are rising. We have the big Fed meeting this week, right? It's what, Tuesday, the 20th of September as we record this. And so lots of things going on. Markets are taking a hit again.
Doing whatever they do.
You're not looking at it, I know, but I am.
No, I keep hearing about it from other people, which is super cool because I try not to look at it. But yeah, it's doing its thing.
I'm going to be honest, though. I haven't looked at it maybe in a month.
Nice. I love that.
So yeah, I just had to kind of check out. I'm finally taking your advice to heart. So I thought it'd be an interesting idea to maybe revisit the cash discussion in light of all the comments that we received on that video. So if people are just listening to this in podcast form, we actually have a YouTube channel and people leave some amazing comments on the YouTube videos. And I was pretty psyched about some of them. And I kind of wanted to talk them through because these are ideas that neither you nor I had, I think, about holding cash, some interesting positions. The first thing that I wanted to touch on was there is a pretty big difference with respect to holding cash for someone who's in the accumulation phase, like me, versus someone who's in the drawdown phase, like you.
Yeah. 100%. And I think that, while I don't know, for us, it's easy to sit here and assume people know our backstory and where we are. And, you put the date, our FI date on the screen, but not everybody does realize that we're at different points in time. And that does clearly drive some of the comments we get.
Exactly. Yeah. I one stood out to me. This was made by Garrett. He says, you laugh because his cash is losing out to inflation, but how's the stock market doing this year in comparison? That really did highlight for me. It's like, well, as someone in the accumulation phase, I actually want the market to be tanking right now as I continue to dollar cost average into it. I keep making weekly buys, whereas you have a very, very different position with respect to cash.
Yeah, I mean, I'd be, first of all, for the market, I'd be totally happy if it just stayed, flat or, continue to increase. That sounds great. Right. Because then,
well, I would too.
I think we'd both be happy about that. But you're happy on the buying side. I'm not doing so much buying. But yeah, for me, cash is different. It's a buffer between the portfolio and living today, right? That's how I fund our, daily or monthly expenses are from our cash bucket. So yeah, cash has a very important day-to-day use, and therefore I hold more of it, typically around 2 years of expenses.
Yeah, totally. Someone else says, Andy says, great conversation, guys. Eric still has an accumulation stage mindset. Just wait till you flip the switch and have to play defense on your portfolio. Less timing and opportunity and more de-risking. I loved that. Like, if only we had said that during our last conversation, right? You are de-risking, and I'm like, pour it on, man. Let's go.
Yeah, and we've had that conversation. I think on one hand, I'm sure you'd be very happy to flip the switch today.
I would.
And be at your FI number and not have to work anymore doing architecture and associated things if you didn't want to.
Right.
But let's say you have flipped the switch. I mean, have you thought about what it's going to be like from a mind shift perspective to not be sort of wired for accumulation?
I have thought about it. And, and I'm kind of trying to role play, put myself in your shoes and say, oh, okay, how would this feel right now? Because I have to prepare for it. And I think as we get further into this conversation, there are some kind of interesting strategies that people are putting in place that are specifically related to people in the drawdown phase, right? There are certain kinds of investments I don't want to be making right now, like in bonds, right? For example, because it's going to hit, the interest paid to me is going to basically, I'm going to owe tax on that at my current, marginal tax rate, right? And that's not ideal for me, but as someone who's holding cash and watching inflation grow, you probably have a different perspective on that.
Yeah. I mean, not that it feels amazing to be holding bonds right now too, but as you know, I have some diversity in my fixed income portfolio too, right? In addition to the treasuries, got whole bond fund, have pure cash. But yeah, I do think about it pretty differently because From one perspective, I know that in a rising inflation environment, interest rate risk is a very real thing for both cash and bonds. But on the same note, from a capital preservation standpoint, I know that my bonds are not down nearly as much as my equities are, and that's to be expected. Yes, the correlation is a little higher than we would like it to be. They're moving directionally the same, but it's also not down as much, that bond position, as is my equities. And so that feels good from when I have to sell, at that twice annual time point when I do my rebalancing, there are some obvious moves I can make, and they feel a little better than the alternative where I only have stocks to sell.
Yeah. And I was actually even more specifically talking about right now. If you look at the yield curve is inverted, right?
Yeah.
You're holding 10-year treasuries just like I am. That's my diversifying asset in our kind of boglehead styled portfolio. But if you look at the 10-year rate and you look at the 3-month and the 3-year and the 1-year rates, ooh, like go look at the 1-year rate. It's higher than the 10-year rate. I mean, that's like the definition of an inverted yield curve, right? So it makes, like, when I start to look at those things, and you and I didn't necessarily pick up on this when we were chatting last, but if you're holding cash, doesn't it start to make sense now to maybe think about laddering in some bond positions, some short-term bond positions, especially as interest rates are rising? If you have a short-term bond that's paying as much as a 10-year treasury note, like, why wouldn't you do that?
Yeah, this is a fair point, and one of our commenters mentioned this. And I think one person mentioned laddering CDs, and another mentioned laddering bonds, and there's a reason that these are popular strategies. And without deep diving on the differences between them, right? CDs largely trend towards shorter, whereas you can get bonds that are pretty far out. And of course, then we have the bills and the notes, the things that are shorter term, which is where you're headed. There's a reason that's really popular, because to your point, you can, buy periodically, whether it's, 13 week, that roughly 3 months or farther out. And yes, you're sort of taking a stand on what you think is going to happen with inflation, but you're doing it short enough term that you're not subject to that sort of term risk that, in a rising interest rate environment. So yes, I have thought about it. I'm thinking about it more than ever. Have I done anything? I have not. I'm still with my cash position, and then my intermediate term treasuries, averaging about 7 years. It's a fair question to ask me.
Well, I mean, I never really thought much about these bond ladders, and just to kind of dig into that a little more. We have a few people who commented on that are just getting ready to transition, and they're trying to build a cash position. And that was particularly interesting to me because, if you look at the definition of what a bond ladder is, it's generally between 5 and 10 different sort of shorter term bonds that you're buying, right? And the way you buy them is you buy them at certain terms so that they're sort of separated in, you can get really granular, but like, let's say up to 3-month expiration dates. So you have one that expires in 3 months, and one in 6 and 9 and 12. And so you can ladder these to start paying you a fixed income as you enter retirement, right? That is your cash position. And for sure that you're going to see all of the yield on that because you're just waiting the full term of that bond. And if we look at, interest rates around 4% for, say, a 10-year treasury versus a 1-year, that's about the same. I mean, that's pretty incredible. A guaranteed 4% on a certain fixed amount of money. That's a pretty good deal. That's a sure bet, right? Backed by the full faith and credit of the U.S. government.
Right. And that is an important distinction when you're talking about buying not only non-callable bonds, but things that are, treasury bonds.
Safe.
Yeah, they are safe. No, they don't have the FDIC specific protection that a CD would have up to $250,000. But you're also going back to some comments we've had in previous episodes, right? If the U.S. government can't pay the face value of treasuries, we have bigger problems.
Yeah.
So yes, safe.
I mean, the one thing that gives me pause when I start thinking about, I started thinking, oh, this is great for building a cash position, and I should really look into this. But these instruments are paying their interest out in 6 months, every 6 months, right? Mm-hmm. And so, you are going to owe tax on those,
That's right.
on all that interest. And, that's not great for someone who's still in the accumulation phase, who's, potentially at a high tax rate. And, even though in my state, state of Maine is like an 8% income tax. So I don't owe any state income tax on those. I still would owe federal income tax on the interest. For someone like you in California, a high income tax state, right? Like that's a pretty good advantage for you, right?
Yeah, and to be fair, one thing I haven't done is actually, as much as I am managing income and capital gains, tax limits, all of those things that are very common in the withdrawal phase, I haven't sat down and done the modeling of what would the true cost be of doing, bringing in other sources of income coming from these ladders. What would the tax treatment of that be versus some? Honestly, I haven't done that math.
I mean, it's funny because, and someone pointed this out in one of their comments, like it gets complicated very quickly, doesn't it? You're trying to.
It does. I thought it was already complicated, but yeah, that does add another layer.
It's like you're trying to manage your income for ACA subsidies, right? Because the cliff is, I believe this year, and I don't know if it's going to extend into next year.
It was extended. Yeah,
it was. Okay.
It's been extended. I think to 2 more years, if I'm not mistaken. Somebody will correct me in the comments, but yeah.
So, okay, that's great. Wow, I didn't realize
it is.
that.
Yeah, that's huge for a lot of people.
That is huge. Yeah, it may even affect me.
Yeah, you might catch the front end of that, or I guess the tail end.
Maybe they'll just keep extending this indefinitely. But
Sounds great.
You're trying to manage all of these different things from you want to still qualify for subsidies, which means your income needs to be at a certain multiplier of the federal poverty limit, right? And you're trying to manage income for taking capital gains, maybe making Roth conversions. It's like this big complex puzzle. And I could see maybe for you, it's just not worth the time to manage it all. Like, why do I need to add like 5 to 10 more different separate bonds, treasuries to into the whole mix and complicate this even further?
Yeah, I mean, the first response I would have is it's a good problem to have. Certainly not complaining, right? This is a very privileged position to be in. But the second comment is kind of harkens back to the conversation we had with Karsten, where some of these things these optimizations feel like we're talking about 4 basis points, just to use the same number that he did in that episode. I haven't done the math here once again. So when I did start looking at some of these alternatives for cash, this is the thing I kept butting up against. It's like, why, is it really worth the effort? And maybe it is, but doing the math is still part of the exercise. And as I've said probably 3 times now, I haven't done it.
Yeah. And
got to do the math.
I mean, also, I think for someone in your position, presuming you can withstand the lockup of an I bond, maybe an I bond is actually just a more efficient vehicle for taming inflation and tamping down some of these worries. Because even if you're making 4% on, a 1-year treasury, inflation's still at 8.5% right now. I can't remember what it is, right? So still kind of losing out.
Yeah, well, I mean, to your point, we discussed this some time ago now, but I did buy the maximum in I bonds for myself and for my wife Lori by taking that out of cash reserves. So it is still part of my 2 years, but that sum of money, that $20,000, is in I bonds and can't be touched for at least a year, and even then, of course, you would be giving up 3 months of interest. But if inflation continues and it makes sense, I would have no issue buying I bonds again, because this is just part of that cash allocation. Yeah,
and the cash allocation seems like it's something that is kind of more fluid, right? It's something you're analyzing and thinking about and moving things around, right? I mean, I know you have 24 months of cash that you're, 24 months of living expenses covered here, but it's something that you're probably always going to be looking at until you decide that the window, the window dressing of the bucket strategy is out the window, so to speak, right? I mean, at some point you're going to dismiss that, I presume.
Yeah, probably. Yeah. I mean, just a thought occurs to me. I mean, part of why I'm not worrying about the cash and is it earning as well as it could for me, right? Maybe it's making 2% right now, and it'll probably go up again when the Fed raises the interest rate. But I'm not worried about it because I already didn't increase my withdrawals this year for inflation. I actually stayed flat versus last year. And how I'm absorbing that and where I'm spending less, or maybe I'm not being impacted as much because some of the most impacted categories like gas, I don't use nearly as much as people who are commuting, for example. But So I feel like I'm already doing a good job of managing spending on the norm. So maybe it's not worrying me as much. Honestly, I'm also trying not to worry about stuff like that. It's a pretty active part of my practice to not fixate on the numbers so much that I'm worried about, oh, am I doing it? I don't know. That's just sort of how I'm handling things emotionally. So I'm not sort of nitpicking away at am I making as much as I could. I don't know if that's the right answer, but I think it's an honest one.
Yeah. You know, the one thing I wanted to still kind of circle back to was this difference between accumulation and the drawdown phase. Because I think when we talk about having cash and building cash reserves, it naturally brings up this idea that I'm going to sit on the sidelines until this market cools off. You know, let's say it finds some kind of level bottom, and, you know, because we've seen a few kind of bear market rallies here, right?
Yep.
There's all this talk of recession. Who knows what's going to happen? Being in cash feels safe to a lot of people. I get that. But there's a lot of opportunity costs, especially if you're earlier in your FIRE journey, to sitting on the sidelines, right?
There is. And, you know, I think the analogy we've used in the past is unless you have this giant mountain of assets far in excess of what you could see yourself spending, you are counting on your portfolio to keep generating income so that you can fund your life expenses, never mind any legacy giving that you want to do to family members or to charitable causes. So it does worry me when we get comments like, I'm sitting on 10 years of cash.
Yeah.
Because I start to wonder, well, are they so well off that they can afford to do that without material concern? Or in fact, is their personal risk tolerance so low that it's akin to somebody who's still working and they stop investing because they're worried, or they liquidate, they go to cash, right? And the opportunity cost, as so many different financial podcasts have pointed out, is tremendous.
Yeah. And also, I mean, the headwind of inflation right now.
Right. Yeah, it's a double whammy, I guess.
It's really bad, right? It's about the worst thing you can do. So yeah, you have to, I mean, talk about being conservative. You and I talked about you having your e-fund on top of your 24 months of cash, right?
It's gone now. It's gone, I promise.
No more emergencies for you?
No.
I mean, but that is a fundamental difference between where you are and where I am, right? Yeah. And, you know, my son was just in an accident and, you know, we have to replace a car now.
Oh, wow.
And as someone who talked, I mean, when we recorded that episode, that had not happened.
Right.
And now we have to come up with, you know, the funds for
the
emergency that just happened. And, you know, I said in that episode, I have access to all these different things. And you know what? In practice, it's not as clean as just having that pot of money set aside. And so, you know, I feel like Laura and I we've learned a little bit here. And granted, that's a fairly large expense to come up with, you know, out of nothing. And so that has its own set of challenges. But, you know, I don't see you as someone in the drawdown phase maintaining an emergency fund. That just doesn't really make sense to me.
No. And it was as much the conversation we had with Karsten, kind of, as well as you and I discussing subsequently, you know, this idea about the structural engineer having factors upon safety upon factors upon safety. So you end up with just the guard bands you've put around something are so big that it just sort of doesn't make sense. And this, you know, I don't want to judge people who are so risk averse because whatever happened to their family in their past.
No, I get
it. Or they came from poor, and that's why they choose to err on the very conservative side. But you were right in that in my case, when I looked at my financial picture, I was putting more safety on than even emotionally I required. And so just looking at it, you know, being honest about the numbers and saying, you know what, that's not what is needed right now. Yeah, it made sense to hold 6 months of expenses when I was still working, because if I was suddenly out of a job, like, okay, yeah, it makes sense. But, you know, at this point, I don't think so. So 2 years, I feel good about. I did not need 30 months worth of buffer. And I think that was a good decision.
It does. I wonder if there's some kind of an in-between in that, you know, 24 months of cash that you have where, you know, half of it is in a 1 year note or something like that, you know?
Yeah.
It's like, it doesn't add that much complexity to it, but it's not losing as much to inflation, you know?
Yeah. Yeah, no, there's some merit to that, and a number of commenters did talk about things that are on that sort of train of thought that could make good sense. Yeah.
I feel like such a novice sometimes when I dip into the comments and people are like, you should really educate yourself on these long-term financial planning moves. I'm like, wow, there was one comment in there. It was about four pages long, and it went through this person's whole strategy and how they're maximizing their, ACA subsidies. And you probably know the comment. And
and I asked him to clarify, and he did.
It was next level stuff. He also, I think, kind of made fun of me for changing my asset allocation. So told me I should just settle on something and stick with it. He doesn't know me very well.
No, he doesn't. But your point's a fair one. I'm thinking of some posts and bogleheads where some of these people just go so deep, and then someone will comment back like, "Oh, are you a financial advisor?" And they're like, "No, I'm like a welder." They're like, "I just love this stuff," and they have done such a good job.
It's amazing.
I love it. I learn something every time I dip into one of those threads.
So Frank Vasquez says, retired, although we still have some residual income, about 12 to 18 months in cash is enough for us, 4 to 6% of overall asset allocation. But cash includes all liquid and low volatility assets, checking, savings, short-term bonds, I-bonds. I think that's probably true for you too, right?
Yeah, I think the short-term stuff up to I-bonds I consider as cash.
Yeah. But he says, this is also a reason not to use total bond funds because they incorporate short-term bonds, but you can extract them or use them as cash. It's better to keep your short-term bonds in a separate fund from your intermediate and long-term ones because they function very differently in your portfolio and you want to be able to rebalance between them. I thought that was an interesting idea. I hadn't really considered that, that bond fund is an amalgamation of a whole different, types and term of bond, right? You have short-term and longer-term ones in there. And if you're truly trying to maximize the use of short-term bonds for cash, especially in a rising interest rate environment, that's pretty smart to consider them that way. I love that comment.
Yeah, it's a really interesting comment, and it caused me to do some more work because honestly, when you hear people, talking about why total bond funds maybe aren't a good idea, it's usually about a different kind of risk, right? It's about default risk because you've got corporate bonds in there, for example, and mortgage-backed securities. It's not so much about duration. So that was an interesting idea. I mean, I guess. And maybe it's not the most mathematically sound argument, but I'm holding something like 60% intermediate term treasury fund and then 40% total bond fund. And I guess in my mind, that's a way to get a little exposure to potentially the upside from corporate bonds in any environment other than the one we're in right now, and maybe some, mortgage related securities. But I hadn't thought about it so much from the 10-year perspective.
Yeah, it's interesting. I mean, we still get tons of bond comments. Why are you guys in bonds? Bonds feel like
all the time.
Somebody said bonds feel like a relic of the 20th century.
Yes.
Might have worked for the bogleheads back then, but why now? But they didn't give any sort of reasoning for what the diversifying asset would be. What would the ballast be in that kind of a portfolio? And I definitely see people waiting on the sidelines to get into bonds again too, once interest rates are done rising. So people are market timing, man.
They are. And I'll tell you what, for all the talk about recession and potential crashes, I'm pretty happy to be not thinking about that, knowing that I've got 30% of my portfolio in fixed income.
Yeah, buddy. I was going to say, I rebalanced. I went from my 70% to stock allocation to an 80%.
You did.
I did that little selling. And I think the last time you talked, I said, is that, am I just being dumb? You're like, well, I mean, if you think you called the bottom correctly, maybe not, but it depends on, how flexible your timeline is. And
exactly.
I have to say,
that's what I said.
Yeah.
I did not agree to dumb. Sure.
But looking at my portfolio now, it's moving. It's moving a lot more than it was, so.
If you want volatility, going more into equities is the way to do it.
Yep, totally.
It's just, what's the volatility going to look like, right?
Yeah.
It's certainly going to be dynamic, to use your word.
Somebody else asked if I had more diversified portfolio than, like, do I have things other than just VTI? And my answer was like, I've got a 3-fund portfolio, but that's pretty well diversified, man.
Yeah, it is. Yeah, you're
total market.
You're holding the market.
Yeah. Anyway.
For some people, they do conflate the idea of diversity with the sheer number of funds,
Yes.
as opposed to representation of market.
Right.
Yeah, that's real. Speaking of diversity and complexity, how do you feel about some of the comments we got about holding complete alternatives to cash, but still talking about them having the role of cash? So maybe on the lighter side, somebody saying, gold or precious metals, which is not an uncommon hedge, but we can talk about mathematically whether that makes sense or not. But on maybe the extreme side, in my opinion, how do you feel about buying real estate instead of holding cash?
Oh, I thought you were going to say vintage coins or vintage weapons or something like that.
Yes, there was an individual who holds vintage weapons and flags.
Yeah, man, I'm not looking to buy into kind of currency risk here.
Likewise.
With respect to those, I've looked at the golden butterfly portfolio. Like there's some of these very popular portfolios which have fairly large allocations of gold and precious metals there. But I think like you believe in the long-term health and stability of our economy. A growing asset such as companies and corporations, to me, that's an investable asset that actually produces income and revenue and value in the world, as opposed to gold, which has none of those things. I mean, how are you looking at it?
Yeah, I mean, a couple things come to mind. The first is that, when you look at any of these financial podcasts who candidly are far more quantitative and more skilled in these analyses than we are, the real returns over time of gold versus the S&P 500, if you look at any substantially long window, it doesn't really matter how long, you should be looking at equities. On the other hand, if you're interested in, and it fits with your investing, sort of policy statement, to have, positions in some alternatives, like I want to be 2% in gold or 4% in silver, that to me, I can sort of get on board with that. It's not personally what I'm interested in. I don't have precious metals in any form, just like I don't have industry tilts in my portfolio. But that's sort of my approach.
It's kind of, I look at it kind of like real estate, in that if I saw a reason that it made sense that I could get behind it, then I might, but I just don't see it. I mean, it's not producing more value in the world. It's like, the reason I invest in cryptocurrency is because I do feel like there's a utility to it. Like if I'm buying ETH, I feel like there's a future utility to that. I see a future there that has usefulness. And, but I don't see the same with gold. Real estate is similar too, for me. And I know some people asked us about, well, is there a reason to just kind of, wait for the stock market to cool down and just pop into real estate here? Right. Move a large holding there. And I know people have large parts of their portfolio in real estate, but for me, like, I own the house behind me. Like that's already a sizable tilt toward real estate in a lot of respects, right? Like,
I agree. I do agree with you, Eric. And to add to that, my position is, again, if you want, whether it's you have a belief that, real estate investment trusts or REITs or private equity, investments in real estate or rental properties are a good, they fit your investing philosophy and they're going to, generate revenue for you, and that makes sense to you, great. I don't have an issue with that. Where I do start to get concerned, and of course this isn't financial advice, but for me, I have a hard time equating an investment in real estate with cash, with saying instead of holding 1 year or 2 years or however much cash I've decided I want to hold, I'm going to just move that pile into real estate. That's a different thing entirely, because the comment I usually make back when people suggest things like that is, what is the job of this asset? And if you're having 2 years of cash, in drawdown, it's buffering, right? This is you're funding your lifestyle out of this. It's liquid, it's accessible. There's
a lot of people would say it's
that.
Cash flow, and
that is.
The answer to that, I think, is, there's a lot of concentration risk if you're buying, say, a set of apartments in a specific market. I mean, who knows what's going to happen to San Francisco the next 5 years. I mean, it may continue to like outperform the other markets, or, you know, the returns on that investment may be paltry, like 3 or 4% as compared with somewhere in the Sun Belt. I mean, but like you, I don't really have a problem with people wanting to do that, and plenty of people do, but
personal choice.
But I know nothing about it, and I don't see myself spending time trying to educate myself to the level where I can make an informed choice about I'm going to invest in Scottsdale, Arizona versus, I don't know, Podunk, West Virginia. I just don't know how to make those decisions. So for me, it's good enough that VTI has like a 4% real estate weighting. Like, that's good enough. And you said you have like a
5%.
Yeah. So you got to tilt somewhere, right?
I have 5% in REIT. So yes, there is a sector tilt in, you know, commercial real estate.
Okay. Yeah.
Yeah.
Because you have some sort of belief.
Yeah.
Yeah. Okay. Cool.
Yeah, I'm not going to touch it. You know, I think it's Rick Ferry that says this, like, it's okay to hold 5 to 10% in REITs, but you're going to hold them forever.
Right. Don't make a change.
Don't make a change. And I haven't. I've had that position for a long time. And I like it. I mean, I guess just one more comment to add on the real estate train. I think even if I got the bug where I thought I'm interested in making some investments in real estate, whether it's, you know, rental properties or some other form of investing in real estate other than my primary residence, I believe, sitting here today talking to you, that I would still hold 2 years in cash.
Yeah.
It's not a replacement for my cash position.
Yeah, that's a good point to make. No, I appreciate that. I want to talk for a moment about high yield savings accounts, which is kind of, I don't know whether you agree it's a misnomer or not. Yielding about what, 2.1%, 2%?
Yeah, 2 to 2.2, I think, is what I'm seeing right now.
Yeah, so
at least for this week.
They're slow to raise rates as the Fed bumps theirs up. But I had a pretty bad experience with a very well-known high yield savings account that I kind of wanted to pass on to other people. And it certainly may not be indicative of other people's experience, but I got the bug to try and move some money around as I was saving for my son's college. Because we didn't want to draw down on the 529. So I'm like, well, I'm just going to build a cash position in a high yield savings account. And I don't want to put it at risk at all, because that's for next semester's payment. Right. Yeah. And so I'm saving for that now. And so I thought, okay, I'm going to go check the reviews. So I checked NerdWallet. NerdWallet has like, our top 10, you've seen them before, right?
Yeah.
And
always.
Highly rated. Right. So I go, so I choose Marcus, which is by Goldman Sachs, and they have a rate right now, which is, I think it's around 2%. Yeah. And super easy to set up. I was so impressed. App for your phone, make all the connections online, you know, because there was other high yield savings accounts that I've had in the past that made it really difficult. I was like, I want this to be frictionless. So I get it in there and I start building the savings in there. And like the moment you initiate the transfer, the button, you know, you're earning interest. I'm like, oh, that's amazing. Like, I don't even have to wait for 1 or 2 day, you know, transfer window to show up. And so I'm building this savings position, and it gets time to transfer the money to pay for the college tuition payment, which is due on August 1st or whatever it was. And so I go to initiate that payment, and all goes through, and, you know, like 6 or 7 days later, I go to check to make sure the money has come out, and it says my account has been locked.
Oh, geez.
I have no access to it. Can't see the balance. Can't see anything. Please call us. So Marcus starts texting me, please call us. We have an issue with your account. So I end up, make a long story short, I ended up 4 hours on the phone trying to divine where this money was. The tactic here is delay. They pass you from one person to the next. So with any of these high yield savings account, you know, online, you know, most of them are online, right? Like, customer service is everything. And it was absolutely dreadful. Great to save. I'm happy to get that interest rate for, you know, low risk saving vehicle, but try and get the money out and forget it. You're completely hosed. So they ended up locking my account. They wouldn't tell me why they locked the account.
Wow.
They wouldn't tell me when I would get the money back. I needed this money to pay that bill, which was coming due, or he was not going to be enrolled in school. And I was like out of my mind, like asking for even an account balance. Like, show me the account balance. I don't even know if the money is there. I don't know where the money is. The college starts calling me. They said, your tuition payment is late. So I'm like, and we had saved everything. We did everything as we thought we should do. Eventually, the money was returned from the college. They reneged the payment back into the Marcus account, and Marcus closed my account. And then they sent me an email saying your money will be returned to you within 30 days.
Oh, jeez.
30 days.
You kidding?
So, I eventually get them on the phone to wire the money back into my regular bank account, which I can walk to.
Right.
I can walk into and see that the money is there and speak to a real person. It was just a nightmare experience. And I filed a Better Business Bureau complaint because it was so awful.
That sounds terrible.
And that is the time when I discovered this happens to thousands of people. Marcus, go look at the Better Business Bureau complaints for Marcus, and you'll see thousands of complaints about this very tactic. Great putting the money in. As soon as you want to draw it down, remove the money, transfer it, they'll close or lock your account. It's crazy.
Yeah, it is crazy. I am sorry to hear that you had to deal with that. Typically, the way I think about high yield savings accounts is it's pretty boring, but I'll explain it. I get that there are teaser rates, right, where it's only up to the first certain amount of money, and then after that it's a more traditional rate. That doesn't sound very interesting. I know that there are people that like to optimize that they use multiple accounts up to those amounts. To me that sounds like spending dollars of your time to make pennies. So I'm definitely not going to do that. So the strategy I took on many years ago now was to find a good bank. It's an online only bank, but a good bank that offered near the top of the interest rate, but still had good customer service. And, I didn't have to worry about any of that stuff. So yes, were they paying 2% when others are paying 2.2? Yeah, that happens, but I've been really satisfied. So,
but have you had to remove the money?
I have. Yeah. It's my regular bank.
Okay.
So basically what I did is I located my regular banking at somewhere that offered competitive rates on their money market savings, and even had a pittance of interest on their checking. So I made that decision 20 years ago now, and I've stuck with them because even though some of these things look attractive to kind of eke out another 1/10 or 0.2%, I haven't even heard examples as extreme as yours, and I still wasn't interested, but that definitely scares me off.
Yeah. It was so easy to set up, and then just the back end runaround, like you said, it's not worth the squeeze. And
definitely not.
My son uses CIT Bank, which is another version of that, but they do the old bait and switch with they give you the teaser rate, and then, now the high interest rate only applies to accounts with this name, the savings micro builder, as opposed to the savings builder. It's like, so it's just, I just ethically, I can't even get behind it. It's just they're doing that for one reason and one reason only. And it just doesn't, it feels real icky. And someone mentioned in one of the comments, go to a local credit union. You'll get a probably an even better rate than you'll get online, any of these online banks. And, everyone's mileage may vary, but I really appreciated being able to walk into my local branch and talk to somebody and know that I could get a balance when I wanted to, and I didn't have to sit for 35 minutes on hold just to speak to somebody and then get cut off. It's just like every possible thing happened with that transaction. It was just,
Well, and this is such a good point, Eric, because, we talk about the fact that cash is meant for expenses in the next 12 to 18 months. It should be liquid.
Yes.
It's got to be accessible.
Yeah.
But accessible means something. It doesn't mean well, hold on now, we're just going to lock this up periodically, and then, our fix means within 30 days you'll have the money back. That's not immediate access.
Yeah, no.
That's just
what? I tried to, I did some research before this just about other options that were out there, and including your bank that you recommended to me. And it's just interesting to look at the terms and conditions that you're signing up for. So one of the ones that I looked at was Personal Capitals, and they have a very straightforward terms and conditions of what you can and you can't do. And I really like that. I haven't used their product before, but I'm kind of considering it now, just because I use all their other tools.
Yeah.
But the terms and conditions for the Marcus account, pages long. It might be 8 pages long, and make one wrong move.
Yeah.
And you're giving,
like anything, they're counting on you not reading it.
Exactly. Yeah. And I didn't until I got in trouble.
Hey, most of us don't.
People like Personal Capital Cash. They also like Ally, and that's one that comes up
very popular
a lot. But rates can and do change quite often, right? And they're going to be quick to change them down, but they're going to be slow to raise them up. But like you said, what's your time worth, man?
A lot.
What do you do with dividends in retirement? Are you reinvesting, or are you just dumping that into the cash bucket?
No matter what kind of account, I have the dividends get thrown into the sweep fund. And then that way I can make the decision what to do with them. But generally what that means in my taxable account, that cash goes into my operating account, because that's, refilling the cash bucket.
Yeah.
Right. It's already been sold. The tax is already there. Just take the money and put it in the operating account. In the tax deferred or tax exempt accounts, I still decide where to reinvest those dividends. I don't automatically have them be reinvested.
So you like rebalance, right?
Yeah, it's an opportunity for micro rebalancing. Yeah. So yeah, that's what I do.
Yeah, cool. I mean, you're a big dividend investor, so I know you.
Oh yeah, huge. I only select funds that throw very high dividends.
You like the dividends when they show up, but you just.
I'm happy when they show up, but yeah, I don't optimize for
them.
No, I don't. I'm happy when it's there. It just goes right into the cash bucket.
Hey, there's one here which I wanted to touch on. Keep dollar cost averaging, or stop investing in my 401k and buy gold. Did we already talk about that?
I mean, we talked about gold. I guess we touched on pieces of it, but
we don't have to.
I don't know. I mean, for me, pretty simple. 401k, more often than not, has a match. So always put it into your 401k up to the match, no matter what. The second you already mentioned, and that is with rates, with market performance dropping, right? Everything's on sale. You're buying at great prices. So why not keep investing? And of course, individual circumstances will vary. If maybe your answer would be slightly different if you're really close to your number, or you're really close to, I don't know, mandatory retirement, maybe your strategy would be different. But if you're in the accumulation phase, for me personally, I want to keep investing.
Yep, that's what I'm doing, man. It's a great time to be investing right now. And we did a video on why I'm not buying I bonds in the accumulation phase, and I break down all of the returns of the market, following a bear market, and you'll be pretty happy to look at some of the returns there, and you'll be happy that you bought things at a discount, because the climb up is swift and steep. And go look at the climb up out of recessions for something like gold.
Yep, yeah, it's very true. On the surface, the idea of holding cash is straightforward and largely not too debatable. There are a few people who say holding any cash is a crazy idea, even in retirement, but that's not the common opinion. But what has been interesting to see the responses to our previous episode is just that some of the different ways people approach cash and the generation of it to fund their expenses, right? And certainly people gave me a lot of different things to think about in their comments, and it sounds like you feel the same.
Yeah, totally. I appreciate the comments. Keep them coming. If you're listening to this on the podcast, go check out the wealth of information that our viewers are offering up. There's a lot of people out there that are much smarter than we are, and it's one of the things that I like about making this show, Jay, is that I feel like both you and I are always a student. That's the kind of mantra that we keep repeating, and we're always learning things. And I know as I'm getting ready to launch myself into FI that I need a cash strategy, and it's nice to have to hear what other people are doing.